Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Okay, why? When deciding between calls and put, it's not just the delta that matter. If a trader sells an option and the IV increases, okay, even if the underlying falls, Vega may overpower any gain in delta. Likewise, a put may have unexpected positive returns. Okay? So here's another example of EUU.
Yeah,
all right?
I could ask if I wanted a long-term.
I'll work on it, Mark. Sorry.
All right. On 11.5, a trader thinks the U.S. dollar is going to increase again against the euro. That needs to say against the euro. Okay? Based on the IV chart, should the trader buy an EUU put or sell an EUU call? Okay? What do you guys think? Should the trader buy an EUU put or sell an EUU call based solely on the volatility? What do you traders think? I see one for buy. Anybody else? If you want to learn how to speculate better with options, this is your chance. This is a great way to get this knowledge, okay? I'm not gonna, you don't lose any money trading with me, okay? All right, we got another B from Larry King. I apologize, and I'm glad, congratulations on your recent retirement, by the way. All right, we see a buy put. All right, so the answer is probably buying a put makes the most sense. And again, the reason being is that, you know, this volatility, you know, I actually showed you what was happening here. This volatility increases. The trader should have bought a put. Okay?
Yeah, wait.
Okay? All right. I mean, you can clearly see what happens here. All right? This put, you buying this cheap vol, you get this big spike in volatility. Let me erase that out. You get this big spike in volatility, plus you get a big drop in the price. You make an absolute, by the time you get here, the put purchase just did so well. All right, this would have been just a spectacular purchase, okay, relative to selling the call. Selling the call wins. It clearly wins, but not in the same way that buying the put wins. All right, you took advantage of buying that cheap volatility, okay? Now, here's another one. If I was bullish on 11.1, okay, what trade would make the most sense? If I'm bullish, if I think the YUK, if I think that the YUK is going to go up, which means the dollar is going to increase against the yen, then what would I want to do on 11.1, which is right around here? What do you guys think? Would I want to buy a call, or would I want to sell a put? I see one for sell put. See a couple. All right, good. Yeah, I would tend to agree with that. I think selling a put makes the most sense. Let's take a look at our chart, okay? You know, we sell our put, and that vol really does drop for us, okay? And now you don't get that massive increase that you would see in that we see in the euro, and in fact, it just kind of sits there for a little while, okay? But even though, all right, even though we kind of sit here for a nice period of time, you can see, matching these up, we don't do much. 1 week later, let me erase a couple things. 1 week later, which is not here, but actually here, based on trading days, you're up 50 cents, even though the stock is basically not the stock, the currency ratio is basically unchanged. YUK hasn't really moved, and those 80.5 puts have made 50 cents in a week. That was that volatility coming out. All right, those Jan puts, all right, it's a real advantage. Okay? All right. That was a quick and easy one.
Hey, Mark.
Yeah.
What if someone says, oh, they want to trade the currency options, but they realize volatility is important, but they don't really want to have that big of a forecast? Is there a strategy? I know that's a whole other hour or so, but could you go through what someone could do if they said, okay, I think that the dollar was going to move up or down, but they were not so certain about volatility?
Yeah, you know, so they think it's going to go, so you think volatility is in middling range, or?
Exactly. They want to have a price forecast, and they don't really want to have a volatility forecast. How can you trade these options rather than just selling an option or buying an option? I know it's
right. You know, there's some really, that's a great question. You know, there's a lot of good ways to monitor that stuff. One thing that you can do is you can set up vertical spreads, broken wing butterflies that will really dampen volatility. You can set up a grouping of time spreads that will dampen volatility. You can get your essentially what I would call weighted Vega down. That's a much more advanced topic. But if you don't have a volatility opinion, the way I like to do things is I'm a big proponent of using vertical spreads and using those to your advantage. You can use 1-point verticals. Heck, you can actually do bullish or bearish butterflies. Okay? One advantage of understanding volatility is understanding how volatility moves with the option. Okay? If we look at our chart here, what do you guys notice? What do you guys notice? What happens to volatility in YUK, at least over this time period? This is a 3-month time period. We don't want to make any huge generalizations, but generally, what do you see? When we're kind of rallying in YUK, which means the dollar is picking up value, what's happening to volatility? Falling. When the dollar is losing value to YUK, or to the yen, what's generally happening? Volatility is, well, you can see it kind of starts to increase here. You know, I think we're right here, okay? So if you are bearish, okay, it can make sense to set up your trade so that you have kind of a little bit of, you get a little help from volatility if you're right, but you're kind of protected if you're wrong. Things like risk reversals can make certain types of sense. So can vertical spreads. They make a lot of sense. Now, if you get into vertical spreads, you can really get into, and here, you know what? I'm going to pull up live vol. I'm going to share my desktop real quick. You guys are all going to get a cute look at what my son looks like.
Great, can't wait. Oh.
Yeah, he's a good-looking kid. Obviously, he takes after his his mother, who is unbelievably good-looking and within earshot. So, one thing that you could really use to your advantage here, Mark 2.0. Yeah, no, I like to joke that my wife and I named him after the person we both love most.
Very, very nice.
Yeah, so let's look at something like EUU, okay, which has some real cool movements, okay? If we look at a skew chart, okay, this is a powerful tool that is available on LiveVol. And, we'll just run it 3 months back.
So what's that telling us, Mark?
I will show you here. Let me run this real quick. All right, perfect. What this is showing us is how the volatility, remember I showed you that volatility surface right here, okay? If we look at this volatility surface while that's running, okay, you can see all the different bumps and how the surface isn't perfectly flat. Every strike is has a little different volatility. And you can use that to your advantage to set up trades, okay? So for instance, let's go back to our volatility chart that we looked at. And I really do like these charts a lot.
They're great.
Here's EUU. Let me pull apart. I wanted to minimize this. All right, let me get rid of the 360 marker. Oop. And, here is 60-day vol over the last, let's go over the last 3 months again, like we were looking at, okay? Now, let's take a look at what's going on here. You've got really, right here we've got really, nice high vol, okay?
That was the peak of the crisis, correct?
That was the peak of the crisis. So, and I believe that was, what was that? I think that was leading in. This was November 30th. Oh, that was a great day to sell that was a great day to sell vol in general, if you ask me. I mean, you could tell that they were going to get a deal done. So here you go, and we're going to pull up within 10% of at the money. We'll just pull up, I'll get rid of September. Let's just pull up the Jan. And you can actually see the shifts in the volatility, okay? So watch what's happening leading into this. So you're sitting here, we're at 136, and you're saying to yourself, you know what, I think, I think we've got to be going lower. But I'm a little afraid of what's going to be, of the fact that we're going to go higher. All right, so what is vol doing on the 22nd? We're at the same, and 60-day vol is on its absolute low end. Okay? I mean, take a look. This is the cheapest it had been, and just about the cheapest it had been in over the last 3 months. And even if you look at a year, let me go down to that 22nd. We're at the high point. We're relatively high for the year, but over the last 6 months or so, we're at the very low point. There you are, 22nd. Yeah. So you say to yourself, okay, I want to purchase something. You buy, but if you're afraid of volatility increasing, what you can do is you can kind of set up something like a ratio spread where you sell at the money and buy 2 puts that are out of the money. Or you can, and you can see, what if we'd sold the 136s at 280 and bought 2 of the we want the puts. So we sell 2 of those at 280, and then we buy 2 of the 134s. Oh, well, let me find the 130. Oh, we can even do the 133s. Let's go crazy. We'll do the 133s. At 165, so you pay 50 cents for the ratio spread. How's that ratio spread looking now? Well, let's do some math here. Vol is way up, okay? Our 136s that we sold, as we've moved away from those, their vol's probably held in a little better than, their vol's probably not increased as much as our upside. So the put we're trading, I'm gonna do a synthetic for you folks here. The call is trading about 80 cents. We're trading $6.17 in the money. So the put's at $7. Okay? Give or take a little interest there. How's that for a synthetic?
Perfect.
Yeah. Now you've got your 133s. The calls are trading 160. Okay? They are $3.17 in the money. 160 plus 317 is 477. 477 times 2 is $9.64. So we made that ratio spread went from 50 cents to $2.64. You made $2 because you bet that if you were right on your direction, that volatility would also go with you. Okay? Boy, I still got it. I have not done that type of stuff in years. That's not true. So yeah, you know, that's really what you can do. It's not even, so there we took kind of a relatively Vega neutral approach to the trade, but we were betting that vol would go in our favor if we were right. Okay? Now, if you want me to lay out that ratio spread, I'm happy to. In the future, I'll write up currency ratio spreads. Actually, that might be a really interesting way to play, based on, especially in something like EEU. Actually, looking back at this thing, you know, ratio spreads might be a real interesting way to play this. You know, buy 1, sell 2 if you think it's going up, and sell 1 and buy 2 if you think it's going down. What do you think, Steve?
Yeah, I mean, it's an interesting way to look at volatility, absolutely.
You know, think about here. If you buy 1 and sell 2, if you bought on the 30th, if you were betting on a rally here, what if you put on the 132, 134 call 1 by 2? Let's take a look here. Here's the 30th. Okay. So you buy the 132 for $2. You sell the 134 at, we'll call that $1.30. So that's you collect 60 cents on the trade. How does this thing do when we rally? All right. Well, let's see. Where do you want to go to? Let's look on our chart. I can even stop at the high. I bet you the high will even be a winner. Let's see, where, that's right here, correct, 12.3? Yeah.
Yep.
All right, so on 12.3, we have a nice little dip in vol. Our 132 calls, let's see here. Our 132 calls, let's see, the puts are $1.70, we'll call that $1.75. They're $2, $2.15 in the money. So what is that? Oh man, what is that? 390?
I think so.
All right, 390. The 133s are. Let's see. Those are. Let's see. They're 15 cents in the money. Those are 265. So that's 265 times 2. Well, actually, that one ends up actually being a loser. I think the price action does get you too much there. at least in the short term, although I think it ends up winning. If you hold on to the 7th, it certainly wins. But yeah, even so, 265 times 2 is 530 minus 390. What is that? That's $1.40.
Right.
And what did we sell it at initially? I forgot already. And it was a little bit of a loser, but not in the same regards as the way our 1x2 was a huge winner going the other way.
Right.
So the idea was we used volatility to our advantage, and now and at 132, it is definitely a winner here. Okay, like if we get to the 8th, here if you get to the any period of time where we're trading around 132ish, that trade is a big winner. So that's kind of it's real interesting the way you can use volatility to your advantage.
Most importantly, understand that it's so important, and that's really the essence of your presentation.
Yeah.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.